Hello students, welcome to BYJU'S IAS. Welcome to a session on economy this week, wherein we'll be taking up some of the very important articles that have appeared in various business related newspapers and we'll be analyzing these particular articles. For this particular video, I've taken the time period from 27th of January to 9th of February 2020. And the articles that I've chosen are from Business Line, Hindu, Business Standard, Indian Express and Limit. Let's begin this particular discussion. The first article is related to Forex reserves. First and foremost, let's look at certain very important points related to the concept of Forex reserves. Forex reserves basically stands for foreign exchange reserves. For any economy, especially an open economy such as India, it is very important to hold certain Forex reserves. Forex reserves usually consist of three very important components. One, it consists of a basket of foreign currencies such as dollar, yen, euro, pound, so on and so forth. Second, it consists of gold reserves. And third, it consists of special drawing rights which are issued by IMF. So the sum total usually is taken together represented in the form of dollar as has been directed by IMF, and every country will usually represent the forex reserves in the form of dollars. Now in case of India, the forex reserves over a period of time have kept on increasing. In the year 1991, we were very close to the concept of a BOP crisis, that is a balance of payment crisis, wherein the amount of forex reserves that we were holding were only sufficient to repay for a fortnight's import of the crude as such. But after that, we have steadily been building this particular concept of a forex reserves. And the article mentions that if this particular building up of forex reserves continues at the same pace, very soon we are going to have a total forex reserves of $500 billion. These particular forex reserves are considered to be essential for the economy. What are the reasons why there is a need for maintaining these particular forex reserves? First and foremost, whenever the dollars will flow into Indian economy, these can flow in multiple ways. Two very important routes of inflow of these particular dollars is FPI, foreign portfolio investment, and FDI, foreign direct investment. And whenever there is a huge scope of a growth in any of the economy, or the international investors are expecting good growth rate from these particular economies, there will be inflow of these kind of investments. In simple terms, whenever there is an inflow of dollars in the form of FPI as well as FDI, it represents the confidence that the international investors have got on this kind of an economy. So it is considered to be a good inflow in terms of dollars. Second, any economy will have certain imports, especially in case of India. We say India is a net importer, which means the value of imports is higher than the value of exports. And when an economy keeps on importing these kind of commodities, it needs to pay in terms of the foreign currencies. Hence, higher the amount of forex reserves, it usually provides a certain cushion for these particular imports to flow in. This usually is represented in the form of import cover, which is often quoted in the newspaper. That is basically the value of imports are compared against the value of forex reserves which are held by the Reserve Bank. In case of India, this particular import cover very recently has crossed more than 10 months, which is considered to be a very good feature or which is considered to be a very good improvement for the Indian economy. Higher the import cover means we have a huge amount of forex reserves which we can utilize to pay for our imports. Next very important reason for maintaining the forex reserves is it will shield the economy from external shocks, such as the concept of Fed tapering. Please understand here, Fed tapering was an unconventional monetary policy that was followed by the Federal Reserve of USA. Post 2008 global financial crisis, this particular Federal Reserve decreased its lending rates, so as to ensure liquidity in the market will increase, growth will be revived. But after certain years, the growth was revived. The Federal Reserve decided that the liquidity that is present in the market was very, very high. And whenever the liquidity is very high in the market, there is a scope of a higher inflation rate. Hence, the central bank wanted to withdraw this particular money from the market. Hence, they used a concept called as a Fed tapering, wherein they increase the lending rates so as to ensure that liquidity in the market will come down. When liquidity in the market will keep on coming down, interest rates or the returns will start increasing. In this particular situation, the foreign investors who had invested in the Indian market will start withdrawing their investments and start investing in the foreign market such as US market. And when they withdraw their particular investments, there will be volatility created in the forex market. That is basically these foreign investors in the stock market will offload their shares or stocks, take the money in the form of rupee, go to the forex market, sell rupee, convert into dollar, take out the dollar. But when they sell the rupee in the market, supply of rupee in the forex market will increase. And this will lead to depreciation of rupee. And whenever there is a depreciation of rupee, it will lead to the imports becoming costlier. So there is certain volatility which is created because of this. So in this particular context, RBI, which is holding huge amount of forex reserves, will take some of these particular forex reserves, sell the dollars in the market, take out the rupees, so as to stabilize the rupee exchange rate in the market. So understand this. Every economy, especially an economy such as India, needs to maintain these kind of forex reserves. Having said so, this article discusses what is a negative outcome because of these kind of inflows and the increase in the forex reserves which are held by RBI. The problem with respect to these kind of flows is this. One, whenever these particular flows will come into Indian market, let's say these will come in the form of dollars. So the foreign investors will bring in dollars, will go to the forex market, sell dollars, purchase rupees. So basically, supply of dollars is going to increase and the demand for rupee is going to increase. In simple terms, in this transaction, rupee is appreciating, dollar is depreciating. And whenever rupee appreciates, Indian exports in the international market will become less competitive, or the prices of the exports will increase in the international market. This will have a negative impact on India's exports. As a result of this, RBI will be again forced to intervene in the market so as to stabilize the rupee. But here comes the problem. If RBI needs to intervene in the market, what kind of a transaction will be conducted? So look at the situation here. Dollars are flowing into India. Dollars are getting converted into rupees. So supply of dollars is increasing. Demand for rupees is increasing. In this context, what RBI will basically do is start selling rupees in the market and purchase dollars from the market, thereby ensuring supply of rupees will increase, the appreciation will be controlled. But here comes the next problem. If the RBI increases its rupee supply in the market like this, liquidity in the market will increase. When the liquidity in the market will increase, there is again a danger of inflation rate. So this is the problem. To control this, article says RBI might be forced to conduct open market operations, wherein it will basically sell the bonds in the market and take out the liquidity from the market. So this is the policy complication which will be created because of this particular inflow of the dollars into the domestic market. And to add to this, the article says how India deals with these kind of foreign flows is actually puzzling. On one side, we are basically encouraging inflow of these kind of dollars in the market, which is reflected in the recent decision taken by RBI to double the limit under the voluntary retention route. Put it in simple terms. On one side, we want inflow of dollars to flow into the domestic market. But on the other side, RBI will intervene in the forex market, try to stabilize the rupee appreciation rate. In this regard, the article states that India's approach to these kind of foreign flows is puzzling. That is, on one side, RBI is basically increasing the inflow of these kind of foreign flows, which is reflected in the decision of RBI to double up the limit under the voluntary retention route. And on the other side, RBI is intervening in the forex market, selling rupees, purchasing dollars, so as to stabilize the exchange rate of rupee. So the article says that Government of India as well as RBI have to come together, identify which kind of foreign flows are important for Indian economy, which have to be regulated so as to control these kind of policy puzzles. So what has to be done now? What is the way forward? The article recommends that Government of India as well as RBI have to come together and make certain policy decisions as to which kind of foreign flows are needed or essential for Indian economy and which kind of foreign flows will create this kind of a issue with the policy making for RBI as well as Government of India. Because please understand, with RBI intervening in the market like this, overall it is going to affect the yield rates in the market. This is going to affect the interest rates in the market also. So what is the way forward? What has to be done in this particular regard? The article recommends that both RBI as well as Government of India have to come together and take certain decisions to identify what kind of foreign flows are essential for Indian economy and what kind of foreign flows will create problems for the policy making for both Government of India as well as RBI. Because please understand, on the face of it, we may say that the forex reserves are essential, but these kind of forex reserves or the inflow of the forex reserves, if they continue, these will create a lot of problem in terms of policy making for both Government of India as well as RBI. Because when RBI intervenes in the market, as earlier mentioned, by selling the G securities in the market so as to reduce the liquidity, this will also affect the yield rates of these particular G securities in the market, which will again have an impact on the interest rates in the market. So this is the basic gist which will have an impact on the interest rates. So this is the gist of the article given here. Based on this, let's have a look at the questions here. Which one of the following groups of items is included in India's foreign exchange reserves? We have already seen this. India's foreign exchange reserves are basically the sum of one, foreign currency assets or basket of foreign currencies, second, special drawing rights which are issued by IMF, and third one is gold holdings of RBI. So the right option will be option B, foreign currency assets, gold holdings of RBI as well as SDRs. So right option is option B. I've also given a descriptive question. The high inflow of a forex, though will provide a cushion to the Indian economy, will also prove to be a policy challenge. Elaborate 250 words. The next article is related to savings and investment. Before looking at the points given in the article, certain very important concepts are: one, what is the concept of savings and investment? Please understand, in any economy, we basically say there are three stakeholders. One is the households, second one is the government, and the third one is firms or companies. All the three stakeholders are involved in the concept of savings as well as investment. That is, let's say a household is taken as an example. The household earns an income of 100 rupee. Out of this particular 100 rupee, it will use 50 rupees for immediate consumption. Remaining 50 rupees is nothing but the savings. But this particular 50 rupees in the form of a savings can be done in two forms. The 50 rupees can be taken and invested in gold, invested in purchasing of a land. These are usually called as physical assets. Otherwise, the same 50 rupees, that is a savings of the household can take it, invest in a bank, invest in the tax bonds which are issued by, let's say, Government of India, invest in any other types of instruments in the market. Now what will happen? If the bank has taken this particular 50 rupees from the household, this particular bank will issue this 50 rupees in the form of a loan, assuming there is no CRR, no SLR, so on and so forth. This particular company which has taken a loan of 50 rupees will either purchase a machine, will set up a new manufacturing facility, will purchase raw materials, will create employment. In essence, it is going to do production in the market. It will either produce goods or services, supply it in the market. But when they produce goods or services, employment will be generated. When employment is generated, the demand for goods and services in the market is going to increase. So in simple terms, you can see that these kind of savings will contribute to economic activity or GDP growth rates. Such types of savings are usually referred as financial savings. Now, why I'm focused on the households is for a simple fact that out of the total savings done in the Indian economy, majority of the savings will come from the households itself. Usually more than 60 to 70% of the total savings done in Indian economy are from the household itself. Remaining will come from the government as well as the firms and companies. And within the remaining two, the firms or companies are the second most or second highest generator of a savings as well as investment. In fact, in case of Government of India, the savings is very, very less, and many a times rather than being savers, these are dissavers. So understand this. To have economic activity, you need the households to save, you need the households to contribute in terms of financial savings. This is a basic concept. Now, what has been given in the article? Very recently, Government of India in the budget has introduced an alternative income tax regime. As per the new regime, the tax assessee or the taxpayer, in simple terms, income taxpayer, can choose the new regime and pay income taxes as per the tax rates which have been introduced. And these tax rates are much lesser compared to what are the tax rates as per the slabs in the present regime. But the condition that has been imposed by Government of India is this: if you want to opt for the new taxation regime, you cannot claim any kind of an exemption. You will not be given any kind of an exemption whatsoever. The problem which has been raised by various experts, the concern with respect to this regime which has been raised by various experts is this: in the earlier years, the Government of India introduced these kind of schemes, these kind of investment options, so as to ensure the households will save as well as invest in the market. Now, if the Government of India says, I will not give you any kind of an exemption if you invest in these kind of schemes, then the household savings and investment in these kind of savings will become lesser. As such, already the savings from the households have declined. The overall savings of the Indian economy were to the tune of around 36% in the beginning of this particular decade. As per the latest estimates, the overall savings of the Indian economy have plummeted or have reduced to around 30% of GDP. Out of this particular total savings, as already mentioned, a substantial amount of a savings came from the households itself. In the beginning of this particular decade, households contributed to around 23% of these particular savings. And as per the latest estimates, the savings from the households have reduced to around 17% of GDP. So in this particular context, the new income tax regime may disincentivize the households from savings as well as investing in the market. And I'm pretty sure you must have read it in every newspaper that Government of India needs to promote more and more investment if there has to be a recovery in the Indian economy. The Indian economy is already in a slowdown phase. If you want to have a recovery from the slowdown phase, that is from having a registered growth of 4.5%, if Indian economy wants to grow at let's say 6%, 7%, we need to promote more and more savings as well as investment in the economy. This new income tax regime is not going to achieve this particular objective. Apart from this, there is also discussion related to the concept of a ICAR in this particular article. What is this idea of an ICAR? ICAR basically stands for Incremental Capital Output Ratio. Please understand, in case of India's planning system, we use a model called as Harrod-Domer model. The Harrod-Domer model basically recommends the relationship between growth, savings rate as well as the capital output ratio. It states that growth is equal to S upon R. That is, the growth is directly proportional to the savings rate and indirectly proportional to the capital output ratio. Here G stands for growth, S stands for savings rate and R stands for capital output ratio. What is the concept of a capital output ratio? Capital output ratio represents how many units of capital are required to get 1 unit of output. I'll repeat the statement again. Capital output ratio, that is COR, is a ratio which represents how many units of a capital must be invested to get 1 unit of a capital. Rather than using capital output ratio, in case of India, we use G is equal to S upon ICAR. That is, rather than using simple capital output ratio, we have replaced that with incremental capital output ratio, wherein rather than having historical investment included in calculation of a capital output ratio, we consider what is the amount of investment that has to be done incrementally from one time period to another time period. That is, let's say within the year 2020, how much investment has been done, how much is the increase in the output. That will give me the concept of an incremental capital output ratio. The idea is to have a higher GDP growth rate, we must control the incremental capital output ratio. The article says that if India wants to achieve a GDP growth rate of 8% at ICAR of 4, then the savings rate must be at 32% of GDP. But that is not the situation in case of India right now. The actual savings is around 30% of GDP. And if India wants to achieve 8% GDP growth rate with an ICAR of 5, then the savings rate must be 40% of GDP, which is much higher than what is the savings rate of India right now. So what government of India needs to do is promote more and more savings as well as investment, and this will not be achieved with the new income tax regime. This is the gist of the article provided here. Now based on this particular discussion, let's look at certain questions. 1. Economic growth in country X will necessarily have to occur if. This particular question as well as the next question, I've taken it from the UPSC paper itself. This particular question basically says, in a country X, economic growth will happen under which of the following situations. First, there is a technical progress in the world economy. Whenever there is a technical progress in the world economy, is there a possibility that India will achieve higher GDP growth rate? Yes, there is a possibility, but any guarantee, any necessity? Not necessarily. Second, there is a population growth in the country X. Let's take the example of India itself. India is the second most populated country in the world and on path to become the largest populated country in the world. Just because India's population is very high, does it necessarily mean that we are going to achieve higher GDP growth rate? Not necessarily. Third, there is a capital formation in the country X. Let me elaborate on this because this is the right option. Please understand, as already mentioned, in the economy there are stakeholders, government, companies as well as the households. All the three are expected to save as well as invest. Out of the total income that is earned by all the three, we expect these particular stakeholders to have certain savings. And these particular savings will be channeled into the market, which will lead to higher investment in the market. So in simple terms, these kind of investments which will be done in the market are calculated in the form of a capital formation. Usually the formula that is used is gross capital formation is equal to the investment done by the economy divided by GDP. Or else I can put it in a simple terms, the capital formation represents a investable surplus that is held with the stakeholders in the economy. I'll repeat the statement again. The capital formation represents the investable surplus that is held in the hands of the stakeholders in the economy. And when I compare this particular investable surplus against the GDP of the country, I will get the gross capital formation. And whenever there is a higher gross capital formation, we expect the GDP growth rate of the economy to increase. So this is the right option. Let me eliminate even the last one. The volume of trade grows in the world economy. If the global trade increases, is there a possibility that India's growth will also increase? Yes, there is a possibility. But does it necessarily mean that with a higher global trade, India's GDP will increase? Not necessarily. Because many a times it has been seen that the global trade has increased, India's GDP also has increased. Because many a times it has been seen that the rate of a growth of GDP in case of the global economy is higher than Indian economy. And many a times a vice versa relationship also has been seen where India's GDP growth rate is much higher than the global trade growth rate. So this kind of a correlationship exists between both of them. So even the last point is not the correct option. Option C is the right option related to this particular question. Now let's look at another question based on this. Again, I've taken this from the UPSC paper itself. Despite being a high savings economy, capital formation may not result in significant increase in the output due to. Basically, they are saying that the savings rate is increasing, but the growth rate is not increasing. What is the reason? Please understand, if the savings rate increases and growth rate does not increase significantly, then there is a problem with respect to capital output ratio. That is the reason the right option for this particular question will be capital output ratio is very high. When the capital output ratio is very high, growth may not increase significantly. So the right option will be option D, high capital output ratio. The next article is related to FRDI, that is Financial Resolution and Deposit Insurance. Now what are the important points? Earlier, Government of India had introduced this particular bill in the Parliament, but there was a large-scale opposition to some of the very important provisions in this particular bill, especially focused on one of the very important provision referred to as bailout provision. Since there was a lot of opposition, Government of India in the month of August 2018 withdrew this particular bill, and now the Finance Minister stated that Government of India will be again reintroducing the FRDI bill. Please understand, the concept of FRDI basically is a summation of two very important concepts. One is the idea of a financial resolution, and the second one is the idea of a deposit insurance. In the recently concluded budget, Government of India has announced that the deposit insurance will be increased from existing level of 1 lakh rupees to 5 lakh rupees, which has been accepted by RBI. Because please understand, this particular idea for deposit insurance is provided by one of the subsidiaries by RBI, that is a Deposit Insurance and Credit Guarantee Corporation of India. This particular authority provides a deposit insurance. Now, apart from this, the second very important concept that is provided in the FRDI is a financial resolution. In case of India, to provide insolvency resolution, we already have an Insolvency and Bankruptcy Code. The Insolvency and Bankruptcy Code will provide insolvency resolution for corporates who have defaulted on the repayment, retail borrowers who have defaulted on the repayment, and some of the financial service providers. But what about all the other financial institutions? Even today, we do not have a consolidated framework for insolvency resolution for these kind of financial institutions. For example, very recently there has been a lot of discussion related to some of the financial institutions in the market, such as urban cooperative banks, such as non-banking financial companies. The performance of these particular financial institutions will have a direct impact on the credit availability in the market, the investor sentiment in the market, the credit growth to various segments in the market, which will have a direct impact on whether Indian economy will reach the goal of a $5 trillion or not, or whether Indian economy will perform up to its potential or not. For example, NBFCs are very important source of credit for many MSME sector units, the rural consumption, so on and so forth. But in the recent times, NBFC sector has come under a lot of stress, especially with respect to availability of credit. So in order to provide financial resolution for these kind of financial institutions, Government of India had proposed a unified framework of financial resolution and deposit insurance. But this particular bill, as already mentioned, was withdrawn by Government of India. Now the Finance Minister says that this particular bill will again be reintroduced. But no specific timeline has been provided by the Finance Minister. You will have to wait and see in what form the FRDI will be introduced. What will be the provisions of the new FRDI bill? Will there be same kind of a provision as it was in the earlier FRDI bill? Will there be a bail-in provision which will be introduced again in this particular bill? So these are some of the points with respect to this particular article. The next article is related to some of the statistical institutions in India. In the recent times, there has been a lot of focus as well as discussion related to the performance of these particular statistical institutions. And the matters have not been helped by Government of India, where either they have rejected some of the reports of these particular statistical institutions, in certain cases have denied publication or making these particular reports public, so on and so forth. Having said so, certain steps or measures have been taken by Government of India in the recent times in order to promote the trust on these particular statistical institutions. Please understand, these particular statistics which are published by these reputable institutions is very important not only for Government of India but for other investors in the market, as these particular institutions have international reputation. Whenever they will come out with certain findings such as unemployment data, GDP data, so on and so forth, this will influence the policy making of not only Government of India but also investment decisions of various stakeholders in the market. In the recent times itself, Government of India has set up a committee which is being headed by Mr. Pranab Sen. This particular committee has been asked to submit a report in order to ensure that there is a submission of good and timely data to the National Statistical Office. Having said so, various experts have stated that the merit or the terms of reference that have been given to this particular committee are very much limited. What should be done by Government of India? The article says Government of India should take two very important measures so as to increase the trust or to reinstate the trust on these particular statistical institutions. One, Government of India should relook into the NSC bill proposal. As per this particular National Statistical Commission bill, the NSC will be converted into a public sector undertaking. And this particular converted NSC will not have any of its own powers. So Government of India should relook into this particular provision of the bill, because NSC is one of the very important statistical institution which is very highly reputable. That is the first very important recommendation. Second one, The article also says that Government of India should put in place a calendar. That is, in simple terms, a timeline must be published by Government of India as per which the data or reports from these particular institutions will be published, so that this will increase the confidence or reinstate the confidence on the functioning of these particular statistical institutions. This is the gist of the article provided here. The next article is related to MSME debt restructuring. Government of India in the last couple of years has taken various initiatives to promote more and more activity under this particular segment of MSME. Please understand, MSME sector is very important in terms of employment generation, in terms of production, not only in manufacturing but also in services sector, in terms of contribution to GVA as well as GDP, in terms of employment generation, in terms of exports, so on and so forth. So MSME sector is under stress in the recent times. And as per various surveys, the NPs in the MSME sector has increased from 11.7% in September 2018 to 12.2% in September 2019. So there is a huge stress in the MSME sector. So Government of India has announced 12-point reforms recently to address some of the issues in the MSME. This particular article discusses one very important reform that has been announced, that is MSME debt restructuring. This was announced by Reserve Bank of India in January 2019. Under this particular MSME debt restructuring, RBI gave an option for these particular banks which have given loans to the MSME to restructure these particular loans. Having said so, there were certain conditions put by RBI. First and foremost, these particular MSMEs must be registered under GST. Second, the total debt and non-debt exposure to these particular borrowers should not be more than 25 crore rupees. Third, these particular accounts of MSMEs should be stressed but should not have been classified as a non-performing assets. Now, what is this logic here? The idea is, whenever a company borrows, let's say an MSME unit C borrows from a bank and defaults on the repayment, for a certain period of time, these particular accounts will be referred as a stressed accounts, but after certain threshold time period, these accounts will be classified as non-performing assets. So RBI stated these particular accounts which will be restructured by banking sector should be stressed but should not be classified as a non-performing assets. By utilizing this particular MSME debt restructuring, the banking sector wants to restructure around 2 trillion rupees worth of stressed assets in the MSME. And so far till the end of November-December, around 50% of this particular target has been met. And the newspaper article says, if the same pace is followed, the banking sector will not be able to achieve this particular target of 2 trillion rupees worth of stressed assets. This is the gist of the article provided here. The next article is related to amendment to the Customs Act as well as the Customs Tariff Act. Recent times, there is a trend of many governments across the world which have started moving towards more and more implementation of protectionism measures. That is, these particular measures can be implemented in the form of tariff policies as well as non-tariff policies. For example, in the last couple of years, US government itself has implemented a lot of tariff measures. It has imposed tariffs on steel as well as aluminum imports which are coming into their economy. Government of India also has implemented large number of protectionist measures. In the same way, many countries across the globe have started following this particular measure of implementing protectionism measures. These kind of measures are usually implemented in order to protect the domestic companies. The government of India has done it, government of USA has done it, many other countries are basically doing it. The article basically discusses one more step that is being taken by government of India in order to implement certain policies which are done in order to protect the domestic market. In case of the trade between India and China, China has got a huge trade surplus. That is, India exports certain commodities to China. China also exports certain commodities to India. But the value of the commodities which are exported by China into India are around $57 billion higher compared to the commodities that are exported from India to China. That is, to put it in simple terms, China enjoys a trade surplus of more than $50 billion in trade with India. This particular trade surplus has become a bigger concern for government of India. Because please understand, China not only exports essential commodities to India, but also exports non-essential commodities to the Indian market, such as plastic toys. So government of India in the recent times has started taking various measures in order to control the inflow of these kind of imports which are non-essential for Indian economy. And since these particular non-essential imports are coming into India, precious forex reserves are flowing out of India. And the measure which is provided in this particular article, which has been taken by government of India, is to amend the Customs Act of 1962 as well as to amend the Customs Tariff Act of 1975. First, with respect to Customs Act of 1962. As per this particular provisions of the Customs Act, Government of India had the power to ban imports as well as exports of gold and silver. Now, with the recent proposal of amending this particular Customs Act of 1962, Government of India wants to expand its powers with respect to banning imports as well as exports of all the goods. So once this particular bill is moved or passed in the parliament, Government of India will have the power to basically ban imports and exports of all the goods. That is the first point. Second point, Customs Tariff Act of 1975 will also be amended by the government, which will strengthen the hands of the government in order to control the dumping activities of various cheaper goods into the domestic market. These reforms will help Government of India in controlling the imports which are coming into India and basically protect the domestic market. That is the discussion which is provided in this particular article. So these are the various articles as well as the questions related to articles for this particular time period. Thank you. Have a good day.